We need to talk about what just happened in the silver market because I'm watching something unfold right now that could fundamentally change the game for precious metals investors. Over the last 48 hours, we've gotten signals from the market that are impossible to ignore, and if you're holding silver or you've been thinking about getting in, you absolutely need to understand what's going on. Gold is trading at all-time highs right now, but it's what's happening with silver that has my complete attention. We just got confirmation from two totally different parts of the market at almost the same time, and when that happens, when the paper side and the physical side are both telling you the same story, you better sit up and listen. A major global bank just raised their 0 to 3-month silver forecast to $150 per ounce from $100. That's a 50% upgrade in their near-term target. At the same time, the CEO of one of the world's largest precious metals refiners came out and said there's immense silver demand in a way we've really not seen before. Think about what that means. You've got a massive banking institution that trades futures and derivatives telling their clients to prepare for 150 silver in the next 90 days. Then you've got a refining company that actually moves physical metal every single day, saying demand is unprecedented. These are two completely different perspectives on the market, and they're converging on the exact same conclusion. That's not random. That's a fundamental shift happening in real time. Let me break down what's actually going on here. The bank operates in the derivatives market, they see positioning on the exchanges, they watch client flows, they monitor hedging activity from big institutions. When they raise a near-term price target by 50%, they're not making a casual prediction. They're managing serious risk. They're telling their trading desks and their institutional clients that there's a real possibility of a move that could absolutely destroy anyone caught short or underexposed. That's the reality of how these big players operate. They're protecting themselves and warning their clients that the old pricing models might not work anymore. On the physical side, when the head of a major refining operation says demand is unprecedented, he's not looking at price charts or technical indicators. He's watching order books. He's seeing metal flow through his facilities. He's dealing with buyers who need actual physical silver delivered right now, not paper contracts promising future delivery. And what he's witnessing is stress in the physical market that he's never seen before. The physical market is under pressure like never before. Here's the data that backs all this up. Silver more than doubled in 2025. That was the best annual performance since 1979. We're talking about 46 years since we've seen silver have a year like that. Then this year, just in the first month, it's already up another 50%. On Monday, silver hit a new all-time high above $117 per ounce, with the biggest intraday jump we've seen since the 2008 financial crisis. Right now it's trading around 110 to 112 after some volatility, but this isn't a bubble that popped. This is a structural repricing of the metal, and the fundamental drivers pushing it higher are still completely intact. The physical market situation is what really caught my eye, because it confirms everything I've been watching develop over the past several months. Retail and wholesale orders are completely outstripping available supply right now. We're seeing massive flows to India that continue to squeeze the global wholesale market. But here's the detail that should make everyone stop and think. Silver is now being air freighted instead of shipped by sea. The exact words were that you simply can't wait for containers to drift across the ocean that long anymore. Let that sink in for a minute. Air freight costs way more than ocean shipping. We're talking multiples higher in transportation costs. You only pay that kind of premium when urgency completely trumps price considerations. When buyers are willing to absorb massive extra costs just to get metal delivered immediately because waiting could mean losing access to supply entirely. This isn't retail investors panic buying coins from dealers. This is wholesale demand, industrial demand, investment demand, all operating in a market that literally cannot deliver fast enough at the current price. When you're air freighting silver because you can't afford to wait for ships to arrive, you're basically admitting the supply chain is broken. You're admitting that physical availability is the real constraint, not price. Now let me connect this back to that $150 forecast. When a major bank models a target like that for 0 to 3 months out, they're not just drawing trend lines on charts. They're pricing in risk scenarios. They're seeing the same physical tightness that the refiners are experiencing. They're watching speculation build in the market, and they're telling their clients this could move violently because the underlying structure is unstable. The bank has made it clear they've been bullish on silver, both outright and relative to gold for many months, and they're staying bullish. Outright bullish means they expect silver to rise in absolute dollar terms. Relative to gold means they expect silver to outperform gold, which historically happens when industrial demand surges or when you get catch-up dynamics after gold has already rallied hard. There's also a speculative element we need to address. The refining CEO talked about this directly. He said you're definitely seeing more price action driven by short-term players in the futures market. Traditionally, silver isn't a heavily speculative market compared to gold or equities. It's smaller, less liquid, more industrial focused. But now we're seeing speculation drive real volatility. Why is this happening? Fear of missing out. Investors who either completely missed the gold rally or got in too late are now piling into silver as a high beta substitute. This is being viewed as a major bet on macroeconomic turmoil and geopolitical risks. When speculative money floods into a thin market like silver, you get explosive price action in both directions. This has been described as a devaluation trade, money flowing out of bonds and currencies into hard assets. But silver's price moves are faster and way more volatile than gold's because of the liquidity gap. Gold's daily turnover in London is about 5 times silver's at current prices. That means it takes less capital to move silver dramatically. When big money wants exposure and the market is thin, price discovery gets violent. We saw that on Monday with the biggest intraday jump since 2008. That's not normal market behavior. That's a market under extreme stress. Let me give you the technical picture because it absolutely matters. Silver broke above its 200-day moving average with real conviction weeks ago. Volume was strong during that breakout. The relative strength index on the daily time frame is elevated but not extreme yet. We've seen RSI divergences signal major moves before, and right now momentum is still building. The 50-day moving average crossed above the 200-day recently, which is that golden cross signal technical traders watch closely. When fundamentals and technicals align like this, it tends to amplify the trajectory. That 150 target isn't just based on fundamentals. It's acknowledging that technical momentum and physical reality are reinforcing each other. Here's what I think is really happening underneath all of this, and it's something the major institutions won't say directly. The paper market is losing its grip on price discovery. For decades, futures contracts and forwards have set the global silver price. Physical metal traded at small premiums or discounts to the paper price, but the paper benchmark was what mattered. That system worked when physical supply could meet demand at the futures price. But when demand overwhelms supply, when metal has to be air freighted to meet orders, when wholesale buyers can't afford to wait for container ships, the paper price becomes irrelevant. Physical buyers start paying whatever it takes to secure actual metal. That's when premiums explode. That's when arbitrage mechanisms break down. That's when futures markets either have to deliver real metal or go into backwardation. We're not fully there yet, but the cracks are absolutely showing. The comments about air freight and unprecedented demand are symptoms of a market transitioning from paper-dominated to physical-dominated price discovery. The 50% target upgrade is the bank's way of telling clients the old models don't apply anymore. When a market shifts from adequate supply to structural deficit, price has to rise until either demand gets destroyed or new supply comes online. But new mine supply takes years to develop, and industrial demand for solar panels, electric vehicles, electronics, defense applications, that's all policy-driven. It doesn't just stop because price rises 10 or 20%. Industries adjust, absorb the cost, and keep buying. Let me address the bearish case because being balanced matters. There are real risks here you need to understand. First, volatility. Silver can spike 20% in a week and give back 15% in 2 days. Short-term speculative players are driving price action right now. That means momentum traders, algorithms, leverage. When leverage unwinds, corrections can be absolutely brutal. If you're trading silver with tight stops or high leverage, you can get stopped out on a spike down even if your long-term thesis is completely right. Second, recession risk. A global economic slowdown could temporarily crush industrial demand. If solar installations stall, EV sales drop, electronics demand weakens, silver takes a hit. That's a real concern, especially if central banks raise rates aggressively to fight inflation. But even in a recession, green energy spending is politically entrenched. Governments subsidize it heavily. It's part of infrastructure policy now. The energy transition isn't purely market-driven, it's policy-driven, which makes it more resilient to economic cycles. Third, supply response. Maybe a major new mine comes online or recycling rates surge or industrial users find substitutes. It's possible, but unlikely in the near term. Mine development takes 5 to 10 years minimum. Recycling is already factored into supply models and hasn't kept pace with demand growth. Substitutes exist for some applications, but silver's unique properties, especially its conductivity, make it irreplaceable in many high-tech and energy applications. Fourth, Federal Reserve policy. If the Fed pivots to aggressive rate hikes, real yields spike and precious metals typically get sold. But current Fed rhetoric suggests they're holding steady or potentially cutting if growth slows. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. If inflation stays sticky despite rate hikes, real yields stay low, which supports hard assets. The macro backdrop right now actually favors silver. These risks are real though. Silver is volatile. That 150 target is a forecast, not a guarantee. The comments about unprecedented demand are observations, not predictions. Markets can turn quickly. If you're holding physical silver, understand price could pull back 10, 15, 20% before the next leg up. If you're trading, leverage and tight stops can shake you out even if you're right. Risk management is everything. So what does this mean for you? If you're holding physical silver, this is validation. The fundamentals are real. The supply-demand imbalance is real. Industrial demand is real. A major bank and major refiner confirmed it on the same day. Structural bull markets don't move in straight lines. They build, consolidate, then explode when pressure gets too high. We might be entering that explosive phase now. For traders, that 150 target in 0 to 3 months is aggressive. If we hit it and drivers remain intact, the next leg could go higher. But volatility cuts both ways. Momentum can reverse fast. Use stops, manage position size, don't over-leverage. For those on the sidelines, you just got two major signals. A global bank raised their target by 50%. The CEO of one of the world's largest refiners said demand is unprecedented and metal is being air freighted due to urgency. You can dismiss this or dig deeper and decide if evidence supports the thesis. The silver market structure has fundamentally changed. A 50% price upgrade and unprecedented physical demand simultaneously are not coincidences. The drivers are structural. Industrial demand, supply constraints, geopolitical risks, monetary policy all push the same direction. The paper market's control over pricing is weakening. When physical buyers air freight metal at massive premiums, the futures price isn't the real price anymore. The question is timing and magnitude. Will 150 happen in 30, 60, 90 days, or will we see a correction first? Will speculation amplify the move or cause a shakeout? Nobody knows. But the setup is there. The fundamentals are there. The validation is there. Do your research. Verify everything. Understand your risk. Don't invest money you can't lose. Invest based on evidence and logic, not hype or fear.